Boesky, he is the CEO and founder of Marco Polo Pure Asset Management and the longest-running Shanghai fund, I believe, since
2004. We're now in our 8th year, and as a same-team management team, we have the longest-running A-share track record in the world now. So,
the word's Marco Polo. Why? Yeah. Out of interest, before we get to the Chinese figures.
We were the first foreign hedge fund operation to specialize in the Shanghai stock market under the QFII program. So, it was under the pioneering spirit of Marco Polo, we took the name. So.
And your business card just gave to me that Marco Polo, the famous image of it. Okay, let's go on to China figures.
Yes.
People think we're going mad.
Okay.
Let's talk about this year, next year again. You're an investor. We won't discuss too much the details of the intricacies of the fund, but I do want to know, for many it's been a tough year. Next year, it would seem there are many elements, you've been saying, that could create a really good year.
Absolutely.
For investing in China.
Next year is a very important year. We have a new president and premier who will be appointed or elected next year, which should be a big sea change for China that hasn't happened in 10 years. So we expect a lot of parades and speeches and inspiration and flag waving. China's very nationalistic. This should be a big motivator for sentiment, which is at an all-time low. Right now, the Shanghai is at a multi-year low, almost a 3-year low. Valuations are at an all-time low right now.
Oversold?
Way oversold, and that's also in tandem with the tightest monetary policy we've probably ever seen. The bank reserve rate ratio, which is the primary tool that the government uses to loosen and tighten liquidity in the system, is at an all-time high at 21%. We just came down a half a point, but the average over the past 10 years has been about 15% RRR rate. We're at 21%, really the highest we've ever been, and Wen Jiabao has begun loosening. So we expect a dovish monetary policy next year, combined with a new administration. Should be a big sea change.
I'm going to play devil's advocate,
okay,
Aaron, and say to you, hard landing, these are the words that have been bandied around, credit bubble, property bubble. We just had a guest on before saying 25% correction in prices and properties. Not so much China, but definitely Hong Kong. Again, he's one of the most accurate forecasters. So all these concerns, these headwinds, if you like, and of course a certain European debt contagion, and indeed the US concerns.
Yes. Well, a correction in Chinese property isn't necessarily bad for stocks. In China, historically, there's been a negative correlation between stocks and real estate. So when the Chinese put the risk-on trade, they push their money out of real estate into the stock market. And when they go on a risk-off trade, they'll draw money from the stock market and put it into real estate, which is considered a safe haven. So during the '08 crisis till now, a lot of money's been drained out of the Chinese stock market. We're at the all-time low valuation, down from 6,400 points to 2,300 points on the index.
So you're going in there saying buy?
The money's come out of the stock market and been pushed into real estate, which is at an all-time high. So you see the negative correlation. Now, if real estate's going to come off 25% and sellers are going to enter the market, where do you think that cash is going to go? So we're hoping for a real estate correction because that's where all the liquidity from our market has been drained into. So we want a orderly retreat in real estate, which we think will be highly beneficial for stocks, and that's already begun, a nice orderly retreat.
What about also the idea post-Lehman's complete drying up of lending, a credit squeeze as was seen in 2008, that's coupled together with outflows because of the risk off the table?
Right. Well, in terms of the way credit in China has been going, it's been extremely tight. Because in the stimulus package in 2008 and 2009, a lot of liquidity was pushed into the system in preparation for what could have been a very hard landing for China. It didn't happen. The Chinese thought we might have overstimulated and pushed too much liquidity in the system, and they started ratcheting up the policy, tightening monetary policy over the past 2.5 years. And we're now at the highest reserve rate ratio in history. So it is very tight right now, and I think the Chinese have been very flexible and adaptive and appropriate timing. So I think they've done a good job to clean up and mop up the excess liquidity of '09. They've done that. We're in the clear. Inflation's dropping. Wen Jiabao's pledge to curb inflation is succeeding. 4 months in a row now we've been dropping. And I think you're going to see a big push to loosen liquidity and loosen credit controls. I think liquidity will be abundant next year.
We discussed before the break how you see next year being a really good opportunity to invest in China.
Absolutely.
Is that stocks, bonds, or just
A-shares, stocks listed in Shanghai and Shenzhen. They are depressed to all-time low valuations. We see a press of liquidity coming into the market next year. A new president will be appointed. It should be a huge year for the Shanghai stock market.
Okay, now, the silver lining out of the Eurozone.
Yeah, there is.
You are almost contrarian on your own, but it's for China, isn't it? It's not for the Eurozone. There isn't a silver lining.
No, but there's a big silver lining for the Chinese.
Right.
You know, China doesn't have a growth problem, and it doesn't have an unemployment problem. We have 4% unemployment, beautifully low. We've got great growth, 9% plus. The problem China faces that the West doesn't, we're talking Japan, U.S., and Europe, is we have inflation problems. That's our problem in China. So when you have...
Today, that inflation problem has got a little bit
That's right,
better.
and that's because of the Eurozone. So weakness in the U.S. and weakness in Europe keep global input prices and commodity prices depressed, which lets China continue to grow at healthy numbers without having a blow up on the inflation numbers. So this is actually the weakness. I mean, if we saw a strong U.S. and European comeback, inflation in China would skyrocket, and that could collapse the economy. So if you ask me what my preference is, as an investor in Shanghai, I prefer an anemic and anemic Europe and U.S. I mean, that's a perfect storm.
Yes, about David Roche said, in fact, as this time next year will be the almost resolution towards Europe, but it'll be the beginning of the U.S. nightmare contagion. You're from Detroit. You've been here there for 9 years, so probably good to be out of America right at this point.
Right.
The U.S. concerns for China, is that also a silver lining, or is that far more intense?
The U.S. concerns.
U.S. debt concerns.
Well, I mean, again, it's the same story all over again. At this point, the only thing, China's focused on building its domestic consumption, its domestic infrastructure. We have a quarter of the world's population, so China's really looking to get out of the export game and into the import business. And imports, we're talking about commodities and inputs. Really, going forward, China only really seeks oil, iron ore, food, water, labor. They want inputs. And as long as those prices on inputs stay depressed, that's a good thing for China. So I think more and more weakness in the West is a benefit for China. 5, 10 years ago, when China was relying on exports in order to build their infrastructure, weakness in the West was a problem. At this point, I think that coin has been flipped.
You're back in China, go to Salt of the Earth, Detroit man, go to Marco Polo Pure Asset Management.